The impact of technology has fundamentally changed the way that consumers and retailers use property. And what this has led to is an overcapacity in the retail market, falling demand for retail properties, and subsequently asset write-downs for a number of landlords. A recent report from KPMG estimated that in the UK there's around about a 30% overcapacity of physical space in the retail market. Demand for retail space is now at its lowest level since 2007, and the volume of transactions is down 45% on 2017 and 60% on 2016's levels. It's this lack of investor interest that has led to significant drops in capital value, and as rents in the lower half of the market have fallen, holding costs have increased, which has led to an increase in yields. Retail real estate investment trusts are now trading at a 45% discount to net asset value. Put simply, for the market overall, it suggests that retail properties are overvalued by about 25%. One of the critical challenges for landlords is the volatile and disparate performance of retailers and the perceived risk for investors. Of course, there are plenty of examples of retailers who are thriving in these challenging conditions, but many are struggling to position themselves to absorb the significant additional costs and also engineer a shift towards a more technological and experience-based business model. In many cases, retailers are struggling to adapt their business models fast enough because they are burdened with too many stores, too much space, and inflexible lease structures. These challenges in part have fueled negative sentiment to the retail property market, and we expect some owners to be affected by further negative asset write-downs. This has already resulted in a shift in the power dynamic between retailers and landlords, leading to a much more collaborative relationship. The result will be a more equitable and transparent lease structure, and in our view, turnover rents will become much more commonplace. However, existing leases will continue to run their course for large swathes of the industry. Into, a large retail landlord, is an example of a company facing these structural headwinds. In their latest trading update, they announced that property assets had been written down by £1.4 billion in 2018. That was a decline of around about 13%. So at an industry level, these pressures are making it much more challenging for companies to inject the sizable capex outlay required to repurpose some of these locations. And because of the higher risk profile, and markets also pricing in steeper rises for interest rates, these turnarounds are also likely to be accompanied by an increase in the cost of capital. These significant changes in the property landscape will also lead to opportunities. We've already seen some evidence of investors buying up secondary locations at discounted values to reinvest and repurpose into more residential and leisure-driven schemes. We're not suggesting the death of the high street, far from it. It's just that the high street is changing. It's evolving quickly, and it's the pace of change that's proving too fast for many retailers, and it's also likely to be too fast for some landlords too.